Good morning, everyone. I'm Rachel Hayes. I'm the Dean of the David Eccles School of Business, and I'm pleased to welcome you to today's Evergreen Company Symposium. We are very excited to be hosting this event for the first time here at the Eccles School and for only the third time anywhere. We're grateful for the opportunity to bring these experts and industry leaders together on our campus, and we're looking forward to some really great content and discussions over the next few hours. I'd like to start us off by recognizing the speakers and presenters who joined us here today. These are national leaders in the evergreen space, each with companies dedicated to making an impact while staying privately held. First, please help me in welcoming Dave Peterson, CEO of OC Tanner, and Dave Whorton, founder and CEO of the Tugboat Institute, who are sponsoring today's event. We will also hear from Dan Canary, CEO and co-founder of Mass Bay Brewing Company, Chris Reuter, CEO of Spikeball, Carrie Van Winkle Greener, co-founder of Pappy and Company, Nicole Muscondas, co-CEO of Nicholas and Company, Josh England, president of CR England, Ryan Young, president and CEO of Yesco, and Taylor Woodbury, COO of Woodbury Corporation. We are glad, excuse me, we're glad to be joined by so many of our great local companies and Eccles School partners, and I'm confident we're all going to learn a lot. We have a packed agenda, so without further ado, I would like to introduce our first keynote speaker, Dave Whorton. Dave Whorton is an entrepreneur, business leader, education reformer, and investor. He started his career at age 16 at Hewlett-Packard and was inspired by the values at that company. After founding 4 companies of his own and working in the venture capital space, Dave founded the Tugboat Institute in 2013. The goal of the Institute is to help entrepreneurs build large, profitable, innovative businesses that can stay private. Today, he will introduce us to what an evergreen company is and what these companies can achieve. Welcome, Dave.
Thank you, Dean Hayes. We're switching over. So I'd also like to thank Dave Peterson from OCTAN for co-hosting this event and the event we have later this week. I'd like to thank everybody who's joined us, the other panelists, the other speakers. I'd like to join everybody in the audience. Welcome you guys here too. Thanks for taking the time on a Friday morning to hear about these really important companies. And I hope by the end of this presentation, you agree with me that this represents capitalism at its best. So a little bit of my background is, as the dean said, I started working at HP when I was 16 years old, spent 4 summers working there, and was exposed to some of the principles by David Packard and Bill Hewitt. Very powerful leaders in Silicon Valley that for a very long time was probably the best place in the country to work for. I'd make that argument. I started 4 companies, as she had said, and I worked at 2 top investment firms, Kleiner Perkins, Caulfield & Byers. I was the right-hand man to John Doerr during the late 1990s. And I was also the lead partner at TPG's venture capital group. So I actually led their venture practice, helped turn around something that wasn't going well at the time, and was exposed to how they approached private equity. I sat in all the partners' meetings for all investments. And then I've been a mentor to the New School's venture fund CEO, starting in the first 10 years. I spent 17 years on its board, and then helped spin out Reach Capital, which I've been an advisor to too. So still have kind of a foot into venture capital through that. These are companies I've been involved with from the very early days, either as an investor or early supporter. So I've had an opportunity to work with some really terrific entrepreneurs and CEOs at some of the most successful companies to ever come out of Silicon Valley. So in 2012, it was time for me to think about raising a 3rd venture capital fund. At a small fund called Tugboat Ventures. I'd raised $50 million in 2006, $75 million in 2009. So on a 3-year cycle, it's about time to go do this again. But my heart wasn't in it. And it's for a variety of reasons that I'll explain in a minute as we get deeper into the venture capital venture experience. But I went on a learning journey. And in that learning journey, I wanted to kind of get underneath this idea, the seed that had been planted in my mind by a woman named Jessica Heron. And she had said to me in 2006, at the same time I was starting my venture fund, which is going to be a good venture fund, the nice guys to work with, she said, I liked you and your partners at Kleiner Perkins, but I hate your model. And I was offended. I mean, what do you mean hate our model? Kleiner Perkins, we back Kleiner Perkins, Google, Amazon.com, all these wonderful companies. She said, no, I don't like your model. I don't think it actually works out for very many people. And I started wondering, where are the Dave Packards and Bill Hewletts? Because in my experience, I hadn't met many of them over the past 5 to 10 years. I met a lot of people that want to make a lot of money, a lot of people that are really ambitious, but not people that kind of had the same values that I'd heard about when I was 16 years old. So I went around to my network and I said, who do you know that you admire and is ambitious to build a significant company that has eschewed venture capital and private equity and its path to a sale or IPO? And most of my friends said, not sure what you're talking about. I don't think those kind of companies exist. At least, well, they're probably lifestyle companies. If they do exist, they're little teeny companies, lifestyle companies. So I kind of kept pulling threads and eventually interviewed about 50 of these CEOs in late 2012 and 2013. Eventually, I probably interviewed over 400, maybe 500. I've kind of lost track of how many. So a lot more than I originally realized when I started this learning journey. And what I realized is there's really two buckets. This is a simplification, but there's the great built-to-flip companies that Jim Collins talks about. These are venture-funded companies. These are private equity-owned companies. These are companies that might have been bootstrapped, but they're going to be sold or they're going to go public. They're not going to stay private. And then this other class, which I started calling these folks as I was meeting that first 50, I said, you know, you need a category, you need a name. And I just like this idea of evergreens. I said to him, what do you think about Evergreen? Are you an evergreen company? Are you going to be around all seasons and around for a long time and kind of pace your growth? People are like, that's kind of a cool name. I like that. So it started to stick. And initially, I thought evergreen companies were just kind of founder owners and multi-generational family businesses. And as I got to talk to more people, I realized, wait a second, there's direct employee-owned models. There's partnership models. There's ESOP models. And frankly, there's foundation and purpose trust models like you've seen recently with Patagonia. It's like, wow, there's a really interesting canvas of different company types sitting over here. And so as I thought about it, it was just this weird kind of, I said, you know, the perception of the world is that these built-to-flip companies, they're everything. That's where all the news is, the media. I don't know how it is here in Utah, but when I went to Stanford Business School, that's all you talked about. The fact the family business owners in my business school class were kind of a little embarrassed. They didn't talk about it a lot, almost like, you know, it wasn't cool. The cool thing was to do something you're going to get big fast. And evergreen companies, I heard a little bit here and there about in the media. I try to get this into every presentation I do. You probably recognize this woman from Theranos. And so this article came out, and they put her on the front page, and they said, she's the next Steve Jobs. 3 weeks later, the Wall Street Journal broke the news that this company was fraud. And as you know, we're still working through this today, and we're going to see what her sentencing looks like. This is us. How to Build a Company to Last 100 Years, written by Bo Burlingham in 2015. We were supposed to be on the front of that. Not me, but one of kind of the members of our group was going to be on the front page of it. At the last minute, the senior editor made the decision to flip this, to put the bright, shiny object, not the lasting, important, society contributing company on the front cover. So somebody say, well, why do you ever show this? I said, I love this, because this explains exactly the things we're fighting against. So I'm going to dive in a little bit with you as an insider on what it's like in the venture capital industry as well as the private equity industry. I don't think many people talk about it this way, so I'll apologize in advance. So this, in my mind, was the moment in which venture capital changed. I think venture capital has made significant contributions to our society and the world for a long time. But something really interesting happened with the IPO of Netscape. And it went public in 1995, 16 months after it was founded. It was losing a lot of money. Up until this time, you could not go public unless you had 8 quarters of profitability and growth. And you had to have a forecast of at least 8 more quarters of profitability and growth, or the bankers wouldn't take you out. Average revenue size, $15 to $20 million, so much smaller companies, and you would be profitable. So here's this company, 16 months old. They're pricing it the night before. The best the bankers can tell is like probably $14, $12, somewhere in that range. That's where the IPO price was set. It opened the next morning at $28, and it closed the day at $75. It was worth nearly $3 billion, 16 months after it was founded. or at least incorporate it. This was like the shot heard all over Silicon Valley. And suddenly there was a new model. This model was pioneered by my partner, John Doerr. And it's called Get Big Fast, Corollary, and Get Rich Too. So they were tied very much into like, this is a high stakes, high energy, get build fast, and we're gonna get really rich as we do this together. Very different feel than kind of the Bills and the Daves. So the dark side of Get Big Fast, and I was a recipient of it, I gave big fast dollars out. I received big fast dollars at Good Technology. I raised $160 million in the first year in 2000. First I raised 60, and then I raised another 100. And we went to market very fast. And so I experienced this myself, but this experience I'm generalizing to many people I know that have shared the same kind of being on the, let's call it the CEO or executive team side of this. So you're overworked and always on. There's constant pressure to do more and more. You have significant time, energy, and stress in managing your board. One of the biggest things you have to do is make sure you keep your board where you need them to be. YPO forums spend a tremendous amount of time on this, helping people manage their boards. That doesn't happen in evergreen companies. 30 to 50% of your time recruiting. Why is that? You're growing 100% a year. You're doubling your staff every single year. 100 employees, 200 employees, 400 employees, 800 employees, 1,600 employees. It is unrelenting the amount of recruiting you're doing. You spend a tremendous amount of time planning, networking, spinning to prepare yourself for the next round of funding. Because if you don't raise that money, you're out of business because you are losing a lot of money. So you only have so much time. It's called your burn rate. And what happens sometimes is you get somebody who offers you a big check and they say, you know what, we like a lot about what you're doing, but we're pretty smart here at our partnership. We think you need to adjust your strategy to do such and such. So what do? Say no to the check and go out of business? Or sure, we'll adopt the strategy your partnership thinks is the wisest. And often they don't know your industry very well. You will, I didn't do this, but I had peers that did, you fire senior executives before board meetings, before they fire you as a board. So you can blame the person in marketing because you really screwed up the marketing thing and you get the board's energy focused on that, hire a new person in and maybe fire a head of operations next time. But you can play this game for about 2 years. Emotional layoffs, this is awesome. So when you do it for the first time, I mean, the founders just can't help themselves. They're just in tears and they're falling apart and everybody's staring at them going, dude, I mean, you're letting me go, but why are you falling apart? I'm the one that's got to figure out how to get a new job. And then you get good at this and you start stuffing those middle envelopes yourself and putting them under the chairs and you know the whole routine to do it in the morning before lunch and you get really, it becomes a natural process. And the reason why you do this is because you grow too fast and you always overshoot, so there has to be an adjustment. It just happens as part of the model. And then unfortunately, you don't mean to do this, but you break promises to customers because you're growing so fast, you're hiring so many people, you're making commitments you can't even keep track of. You do the same thing to your suppliers and your partners. And again, it's not on, you don't do this on purpose. You're not bad people. You just can't keep track of all the things you're committing to do. And then after all of this sacrifice, again, felt really on the CEO team side, 9 out of 10 of these companies have no economic value in their stock options, 0. And so go do it again. And the one that's most painful today is preferences. So you have a company, it's a $100 million exit. You read about it in the Wall Street Journal, and that'd be a low number, but 100 million. And you're like, hey, I'm a VP of operations. I have 1% of this company in stock options. Well, I made $1 million on top of my salary. That's not too bad. And then you find out you got nothing. You're like, how did that happen? How did I get nothing? Well, the company raised $25 million and had a 4x preference on that. So the investors got 4x their original investment back before there's any money available to the common stock. There's nothing left. And this happens over and over again now because these preferences have become very common ways to get higher valuations. To get a unicorn valuation, you have to do is you put a large preference on it, which protects the downside of the investors, but it takes a tremendous amount of the economics out on an acquisition. So these companies were now being built to raise cash, not to actually generate cash. The old model, the pre-Netscape model. So I think you're gonna love this stat. So this is the venture capital industry from 1960 to 1999, almost 40 years. $25 billion was raised and deployed in that period of time. Some of you may remember Fairchild, a very important contributor in Silicon Valley. Tandem Computers, the first major win for Kleiner Perkins. Intel, these probably start getting a little more familiar. Microsoft, Genentech, Apple, Adobe, FedEx, Sun Microsystems, even Starbucks raised venture capital. Cisco Systems, Electronic Arts, Amazon.com, Google. Just a representative sample of people who actually raised and participated in that $25 billion of capital. $3 trillion of revenue. Pretty good investment. 25 billion, 3 trillion in revenue. That's probably net good for society. One firm over a 9-year period raised $29 billion. They did 17 billion in revenues last year, and they've been unprofitable since formation. Which company is this? Uber. This is Uber. Can you imagine one company took in more capital than the entire venture capital industry over 4 decades that led to companies that generate over $3 trillion? What is going on here, guys? This kind of stuff's going through my mind in 2012. Here's a little secret. You're going to love this. Bill Gates didn't need the money. Bill Gates sold 5% of the company for $1 million to Dave Marquardt of August Capital. Dave is a remarkably talented venture capitalist. He didn't need the money, he just wanted the talent. And Dave trades in stock. You want me? I have to own some of your company. Larry and Sergey, I actually led the negotiations with Larry and Sergey for the investment we made in the company. They raised $25 million for 25%. And the math was this. Most VCs want 20% ownership. They wanted John Doerr. They wanted, I'm blanking on his name, it's Sequoia, Mike Moritz. That's 40% dilution, more than they wanted. So they started kind of trying to negotiate, how could I get both venture capitalists in with the minimum amount of ownership dilution possible? And we were trying to each get 15% for a total of 30, and they were pretty stubborn about this. We finally agreed to 25. So 12.5% to Kleiner Perkins, 12.5% to Sequoia. You get John Doerr, you get Mike Moritz. They were already selling boxes for search and corporate environments. They actually really didn't need the money. And it only took until 2013 to really figure out the AdSense model, the AdWords model, and as you know, the thing took off. So in truth, they really didn't need the money, they did need the expertise. And to give credit to John Doerr was instrumental in the success of this company. I saw it from inside, and tremendous contributions. I'm not sure the company would survive without John's participation. Amazon, Jeff Bezos, people think like, God, they must have raised billions and billions of dollars. No. They raised $9 million. About $1 million was angel, and the rest was Kleiner Perkins. They went public and raised $50 million. So, ooh, that's gonna be hard to do. And so in this first 10 years, that was it. Now what they did do is they did raise some debt, over $1 billion of debt from Europe in 1999. It was largely a debt finance company, not an equity finance company. So here we are, 3 of the greatest venture capital investments of all time, each worth over $1 trillion, was practically self-funded. Isn't that incredible? And then think about Uber raising $29 billion. What a disconnect. Also, I think this should inspire evergreen companies. You can build really successful, large-scale companies without a lot of outside equity. So don't buy into the story. You have to raise $29 billion to be successful. Arthur Rock said this, and I was right at the time of my learning journey also in the Wall Street Journal. And the punchline was basically, these guys are arrogant. Today they feel like they want to cash out as quickly as possible. That isn't how I played the game. And that's kind of how I was feeling too. So let's switch to private equity. So this chart is a little out of date. I couldn't get more up-to-date information, but private equity has been quietly growing and growing and growing. It is substantially bigger in the number of total firms that are private equity owned to public companies by about 2 to 1 now. And most people, I don't think, are aware of this dynamic. It is a significant dynamic in the US economy. And why it's so significant is they've got a playbook. They've actually got 2 playbooks. I'll talk about one of the playbooks. This is the buyout playbook versus the roll-up playbook. This is just a case example. There's a lot of public information about it, so I can share this with you. When they bought the company, they put about 5 times net debt to EBITDA on it. No evergreen company would ever do this. They might do 1x, 2x. Most evergreen companies have no debt at all. It's a very common thing. 5 times. They raised the prices immediately. That's good for your customers. They moved 90 to 180 days on the suppliers. So they push financial burden onto their suppliers. Not really good for the suppliers. With the zero-based budgeting, they cut the corporate headcount. They started replacing their senior tenured people who were expensive with young go-getters. That's the 3G model. We got these really smart young guys. We put them in and throw out the guy that's 50 years old. We have to pay too much money. They downsized their real estate by 2/3. They moved their headquarters from St. Louis, its home, to New York City. Budweiser is coming out of New York City. Moved to flimsy packaging. They changed their outsourcing model to move to cheap consultants for their expensive, relatively expensive inside IT folks. And then pretty harmfully, they cut philanthropy from $38 million to $16 million. And St. Louis bore most of that burden. They cut most of it out of St. Louis because they weren't there anymore. So why support the community they had supported for decades? But they did one really cool thing. They said, for you millennials, you can wear jeans now. So the upside of this acquisition was she could wear these jeans. Probably not as holy as these, but you got jeans in the office. This is a note that's not related to Budweiser specific or Anheuser-Busch, but I found this little stat about In-N-Out managers are paid $83,000 on average versus Burger King, which is owned by 3G, or at the time by 3G also, $38,000. That's like a $50,000 gap. I would argue that gap is going to pay off the debt. So they're on the backs of those managers is how they ultimately do these kind of financings with really high leverage. So this is an incredible stat by Doug Tatum. He believes, through his analysis, that 20% of businesses are now owned by private equity, either directly or indirectly. 20% of all businesses in the United States. If you think about the playbook I just told you, what do you think the employee experience is for most of these people in this 20%? And then let's talk about returns. Are these private equity guys earning fantastic returns? Well, Warren Buffett will tell you no. Because if you take unlevered returns on common stock and you compare it to unlevered returns on private equity, common outperforms private equity. You would be better off borrowing money yourself and then putting it into a diversified ETF than actually investing in a private equity firm. And he's said this over and over and over. He's been saying it for decades, and nobody's listening. Most importantly, the limited partners that give the money to the private equity firms are not listening, because now they're sitting on $1.4 trillion of dry powder. Match that with a little bit of debt, and they're looking at about $3.5 trillion of purchase capacity they're sitting on right now. A tremendous amount of resources. So in my view, this tough playbook will continue for some time. It's going to be brought to all facets of the US economy. We're seeing this in the Tugboat Institute membership. They're going to do buyouts, they're going to do roll-ups. Eventually, they're expanding into Mexico. I've talked to Mexican entrepreneurs. They're saying we're seeing private equity in a way we've never seen in history. And at the end of the day, which is really sad about this, is that in most of these private equity firms in particular, there's usually one or two partners that get all of the economics. That's just the way it works. So you think about all these employees, all these jobs cut, all this philanthropy going away, shutting down these locations so that a few people can have tremendous economic rewards way beyond anything they ever could spend in their lifetimes, their children's lifetimes, their grandchildren's lifetimes, and beyond. It's remarkable. And then people say, well, why isn't there more people talking about this? Well, the problem is a lot of people make a lot of money by the built-to-flip model. Bankers, law firms, luxury good providers, private wealth management firms, strategy consulting firms, Bain and McKinsey, a huge chunk of their practices now support private equity. That's what they do now, a huge amount of it. Then I had this kind of moment of clarity for me back when I was doing my learning journey. I visited the CEO of a Silicon Valley law firm. We had a nice conversation about Evergreen, trying to encourage him to take a couple of his top partners and maybe direct them towards supporting Evergreen companies going forward. And I thought we were having a pretty good conversation. As I'm driving later that night on El Camino Real by Stanford University, because I'll never forget this, the phone rings. I'm not sure who it is, and introduces himself and says, "What are you doing?" "What are you doing, Dave?" "The current system works well for all of us. You've got a good track record. You should go back and raise another fund and let this go." I was like, whoa. All right, well, I'm gonna do the exact opposite because that's the kind of guy I am. So you wonder why 50%, under this Harvard poll a number of years ago, of millennials don't support capitalism. I mean, it doesn't really feel that good. It doesn't look like it's really a model in which people share in success. So let's switch to Evergreen companies. So here's what I learned, and guys, I'm gonna run over a little bit, so I apologize, but Dave said I could take a little bit of his time off the calendar. So some time ago, your founders, this is Obert Tanner, for example, made a really important decision. I'm not gonna pursue society's current definition of success. I am gonna do the right thing in building a business to my values. And I'm not gonna do it to just enrich myself. I'm gonna do it, and definitely not at the expense of others. I'm gonna do it together. I'm gonna share in that success. And I'm committed to excellence, longevity, dynamicism, a deeper relationship with human beings. They're really focused on this. They want a deeper relationship with human beings. They want to grow from their own fuel. They want to use modest, if no debt at all. And they want to share in success. They want to be a strong part of these communities within their companies and outside of their companies. And they're thinking well beyond their lifetimes. They're planning ahead. Obert's The Transition document is just a beautiful document that kind of lays out how he thought beyond his lifetime. So there's 7 P's that we've used to define what it means to be an evergreen company. So it's a good name, but the name needs some substance. It's these 7. I'm not going to go through the definitions for sake of time. You're welcome to go to tugboatinstitute.com and you can read these more carefully. But those 7 work together to lead to these beautiful companies that last a very long time. Evergreens are in great company. Some people ask me this. They say, who aren't familiar with it, like, who are evergreen companies? Here's some just logos you'll probably recognize. That's why they're up here, but we could put all of our Tugboat Institute members also in this green circle, so not to exclude them, but just some wonderful companies I'm sure that you guys work with. The advantages of being evergreen are fairly tremendous in my opinion. First, these values are enduring. Those are enduring values. They lead to better outcomes for employees, suppliers, customers, investors, families, and communities. And it starts with having a meaningful purpose, that North Star. Second, pragmatic innovation fosters unexpected creativity, continuous improvement, new growth vectors, and it's all done in a very capital efficient way. You're not wasting your capital. You don't need other people's capital to do this. Compounding leads to very large and impactful companies if you keep a company private for decades. And there's a significant source of competitive advantage by being evergreen because you can do things public companies can't do, that private equity can't do, and venture capital can't do. And in almost all markets, if you're patient, you can win. There's a very few exceptions to that, which is a winner-take-all market where getting there first may give you an advantage. Not in all times, because remember, Friendster was there before Facebook. It didn't happen in that case. But it's a very narrow number of situations like that, though the venture community wants you to believe it's almost all companies today. So let's talk about a few of these in just a little bit more detail. Competing on longer time horizons, I want to bring this really to life. Public companies compete in quarters, but I can tell you, having served on a public company, if you're not going to make the quarter, your board is focused on one thing, either making the quarter or explaining how you didn't make the quarter in such a way your stock price doesn't go down. Tremendous amount of energy around this. Private equity-backed companies will tell you publicly that they're operating in 2 and 3 year timeframes. They're actually operating in weekly timeframes and monthly timeframes. If you talk to CEOs of private equity-owned firms, if you start missing your numbers as frequently as in a week, you will hear from people in that firm. They will be in contact and they will likely send people on site if they're not there already. And they will do this. And so the rope is so short in private equity, people dream of being public CEOs after being in these environments. Private equity companies, evergreen companies can compete easily in 5 year timeframes. They can compete in 10-year timeframes. And I love this quote from Jeff Bezos, who I think has many times proven as a public CEO his ability to tolerate long planning horizons and investment horizons. He says, in order for innovative ideas to bear fruit, you need to be willing to wait 5 to 7 years. And most companies just don't have that time horizon. Well, by definition, public and PE don't have that. And venture capital can. Often they're not given it, but they could have that. And I love this from Clayton Christensen, who's now passed away, but he said, this idea of evergreen companies being impatient for profits and patient for growth is a really powerful idea if you're going to create market-creating disruptions. We create a whole new market. You have to be patient. You have to be focused on profits and let the markets develop and the technology develop into them. It's a longer story, but we can talk about that another time. And you don't have to chase growth blindly as an owner or manager in an evergreen company. We want these really idealized, smooth venture capital, private equity-backed firms up and to the right, quarter after quarter, year after year. The truth is that's not how companies grow. And we see this in evergreen companies. Sometimes they grow and they have to flatten, absorb, that growth, and they grow again, and then absorb and then grow again. But it's not this kind of stylized, idealized, smooth curve. You grow as the markets allow you to grow, as your financial resources, your cash, as well as your human talent and management team is able to grow. And you can focus on things like economic profit, not just top-line growth, because in the big, fast model, that's all that matters, top-line growth. And again, you have this wonderful benefit of compounding over time. So in the short run, to really highlight this power of compounding, here's a case example. Let's say a company's doing $3 million in EBITDA. It's growing at 15% a year. So it'll be about $5 million of EBITDA after 5 years. You know what these things are called in the venture capital world? Living dead. It's the worst thing in your portfolio. It's not getting big enough to exit, but it's not something you can easily kill, so you have to still report it to your limited partners. So at some point, you'll figure out a way to shuffle it out of your portfolio. So let's take another scenario, and this is a more ambitious, short-term minded fella, built-to-flip guy. He takes some money from outside private equity firm, starts growing much faster, maybe not sustainable, but much faster, and they agree, it's time to get out while the getting's good. And so they sell the company for about $150 million. The founder had sold 2/3 of the company. This is a aggressive private equity firm, growth private equity firm, so they want to own the majority of it. And they basically pat him on the back and say, you did a great job, you made $50 million pre-tax, you're on your way, please don't come back to the company. And the new firm takes possession of the company and does what it's going to do. But let's expand the time horizon now to 3 decades. So that's that little blue curve where he sold, got his $50 million pre-tax. What if you extended that 15% growth rate over 30 years? This company is now doing $200 million of EBITDA. And it's still growing. Next year will be $230 million of EBITDA. It's on its way to $300 million of EBITDA. Still 100% private, same ownership as it had before. Tremendous resources to reward your team, to reward your owners, to do philanthropic work in your communities. Somebody shows up and says, look, we need $1 million to save something in the local community. This entrepreneur just writes the check. If he believes in it, just writes it. He has those kind of, she has those kind of resources. And so it's a very powerful thing to give these companies a chance to compound. But compounding doesn't just end in financial compounding, you're compounding employee relationships. We heard this at OC Tanner. You've got companies, people, 20 years, 30 years, 40 years of service. Think about the knowledge, the relationships, what they're bringing to bear inside your company. Your customer relationships, these are transcended transactions. These are now partners who stick with you for decades. Same on the supplier side. These suppliers are now part of how you think about innovation. They're actually part of how you design and serve your ultimate customers. And lastly, community relationships. These companies, Evergreen companies in these communities are tremendous contributors that you can count on. They're going to be in there, good jobs, happy employees, and supporting the local needs of that community. So a professor of mine said this at Stanford Business School. I have tremendous respect for him. He'd been there for about 40 years. He's now retired, and I've talked to him about this Evergreen concept. And he said to me, Dave, I think this is pretty exciting. He goes, but you got to realize the greatest calling of a company is to be a public company. That's the greatest calling. You should form your company as an entrepreneur with this as your objective. And I'm like, oh, after this whole conversation about Evergreen, I believe he was correct before Netscape. I believe the capital markets and the investors and such, that might have been a fair argument. Not today. That's not what is happening in the public markets and not to the companies leading up to the public markets. So I like to say the greatest calling of a company is actually to be an evergreen company today. And I do think that is capitalism at its best. Thank you very much.